Wow, that was a pretty epic sell-off we had in the S&P 500 today. We were down over 1.5%, and only 6% of the components within the S&P 500 managed to close in the green today. So it was an overwhelming victory for the bears, largely due to Jerome Powell and him getting grilled on Capitol Hill here today, and we'll hear more from him tomorrow as well, so buckle up from that perspective. But I think the market is starting to believe that he is going to do his best to fight inflation with everything that he's got. And we did see that the 3-month Treasury yield surpassed 5% in today's market. We have a nasty inverted yield curve. We also saw that the Dow gave back all of 2023's gains with today's wipeout. And we're also going to take a look at a number of sectors that were out of favor in tonight's analysis. We'll then get into a trade application example where I wanted to focus on a well-known consumer name that is really out of favor to the point of having a monthly oversold cluster signal that's also in an attractive area for its dividend yield over the past decade, and we're going to look to sell a put on it. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 7th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever these videos come out. And also at the bottom of those emails, you'll find which stocks are giving you overbought and oversold cluster signals. I imagine after today's heavy selling, there's going to be a lot of oversold cluster signals in the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet on these Market Outlook related videos. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us. And as I was joking on Twitter here just a moment ago, I just could replace this with a bunch of red starbursts or cherry or strawberry starbursts next to one another, and it would look much the same because, as you can see, there's very little in the way of green after today's selling. And for those of you that might not have been aware of what kind of spurred on the selling, Jerome Powell was testifying in Washington, D.C. today in front of a bunch of senators, and apparently the market didn't really feel too comfortable with what he was saying, which is basically Jerome Powell talking tough once again. And David had an interesting tweet earlier today as well regarding the odds of a 50 basis point rate hike in the month of March, so basically later on this month, now being a greater possibility than a 25 basis point hike. And before today, that was not the case. The market was assuming we would be kind of continuing down this path of, maybe dragging out the raising interest rate time period, but, keeping them at more modest increases as opposed to some of the bigger 75 basis point ones that we dealt with last year. And so that kind of spoiled the party here today to a degree. And market participants were selling first and asking questions later. So a really challenging day. And he's not done. We're going to hear from him again tomorrow, if I'm not mistaken, as well. And we've got some other economic reports coming out later this week, including jobs on Friday. Last week when I was with you, I was questioning whether we were going to get the jobs last Friday or not, because technically that was the first Friday of March, and usually it's released on the first Friday of every month. But maybe with just a day or two, they didn't have enough time in that instance. I don't know exactly what their rules are around that. I'm sure if you were curious enough, you could look that up out there. But just to make sure we're all on the same page, that jobs number is actually coming up this Friday. So that has the potential to perhaps light a fire under the market one direction or another as well. But today's selling, I think, is courtesy of Jerome Powell mostly here in this case. And you can see very few stocks managed to be in the green. Somebody on Twitter had mentioned that at least Costco was green, and that's true. Costco was one of just 30 stocks that managed to close in the green here today. up 0.43%. Northrop Grumman, of course, a big aerospace and defense military contracting company, up about the same amount. We had some airlines that were up today. Delta and UAL both had fairly nice days, up over 1 and 2% respectively. We had one energy stock that was up but less than 1%, and a smaller one at that, Coterra Energy. We had a really nice day here out of Dish Network, but that's a very small company these days. In fact, I wouldn't be surprised if it gets booted out of the S&P 500. It barely even shows up on here because its market cap is only $6 billion. And these days, the smaller S&P 500 companies are usually around those market caps of around $10 billion. So I imagine that one of these days we'll probably get a press release that Dish is being kicked out of the S&P 500. We did see that Ulta managed to close the day about 0.5% higher. I don't think Dick's Sporting Goods is in the S&P 500. If it were, it would have been a bright green one as well. Some of you saw my tweet earlier this morning that Dick's Sporting Goods actually raised the dividend by over 100%. You don't see that very often. For those of you that don't live in the United States, Dick's Sporting Goods is a kind of a mall-based sporting good operator. So probably not as well known internationally, but fairly well known from a consumer perspective here in the U.S. And that stock was up nicely, not just on the dividend announcement, but also the reaction to their earnings. Over here in the tech world, we did have AMD up over 1%, and then ON Semiconductor up over 1%. And then over here in the healthcare world, we had Merck that was up 0.15%. And actually, when I checked the Dow Jones Industrial Average heat map, it was just as bad as this, with Merck being the only Dow Jones stock that was up today. All the rest, now there's only 30 of them total, but 29 out of the 30 stocks in the Dow today were down, with Merck barely in the green by the slimmest of margins. So nearly a clean sweep there in the Dow today. So that's about it. There's not a whole lot of other green out there. And in terms of what areas really got blasted the worst, I'd probably put financials front and center in that conversation. You can see once again those banks got torpedoed. We had a day like that last week as well. Some of these fairly well-regarded banks, PNC Financial as an example, down 4.5%. Wells Fargo down over 4.5%. Truist down nearly 4.5%. M&T Bank down over 5%. These are some big numbers, and we're not talking about small companies. PNC is a $58 billion company. It's not nearly as large as JP Morgan, which is $400 billion, and it lost about 3% today. Nonetheless, these are sizable givebacks here today, which was mostly just on the negative sentiment on Wall Street. This was not something that was stock specific in terms of a banking stock came out with these really bad numbers or something like that. It was just really bad reaction to what we are hearing from Jerome Powell. So terrible day for the bulls. Of course, a glorious day for the bears. So those of you that have some bearish trades out there, hopefully that helped you out here today. I know for myself, I was thankful that when I was last with you on Thursday, I had done the Cisco bounce trade as just a stock trade in the trade application example. That was Cisco Systems. It was down today, not tremendously. It was only down about 1%. But some of you that, at least the premium members of Market Scholars that get our Telegram alerts, will know that I was able to shut down that trade at max gain within the first couple of minutes of trading on Friday. So I got into it with like 15 minutes left on Thursday afternoon, and within the first couple of minutes of trading on Friday, we were out at max gain. And, I was thankful in that case to catch the right side of the trade because the market did pretty well that particular morning. And this is an example of how sometimes swing trading can help you be more nimble and agile and help you kind of avoid disaster that might be waiting elsewhere, right? Trend traders and dividend investors and value investors and what have you oftentimes are in trades for much longer periods of time. And there's, of course, pros and cons to every single approach. But this is a fresh reminder that if you are agile in this market, getting out while the getting is good, you will maybe have a smile on your face if you then witness that stock roll over with the rest of the market a couple of days later. So feeling kind of lucky on that particular one. But to be fair, I had a trade a couple weeks back on, I think it was Abbott Labs, that was the exact opposite, where it went to max loss. So it does work on both sides. But those are kind of fun ones when you get in one day and you out the next day at max game. So thankful for the small things here as we look at what was really a pretty horrific day in the market. You can see Tesla, by the way, was down over 3% today. Of course, one of the bigger companies out there. Apple and Microsoft were each down over 1%, so it's certainly not the worst performers, but certainly not helping at the same time. I saw a bunch of chatter on Twitter earlier today that the Goldman Sachs upgrade of Apple, I think it was just yesterday, was classic timing there. Of course, from a sarcastic perspective, because Apple has already rallied 20% off of its lows here in recent months, and finally Goldman Sachs comes out and upgrades it to buy at exactly the time when the stock market rolls over in a major way. So we'll see where that goes from there. But the timing of that particular analyst note was a little bit amusing. Of course, Apple being the most influential company in the S&P 500 these days, as it is a $2.3 trillion company, doesn't do us any favors if we want the market to be advancing higher. We would need the backing of Apple to help us with that in all likelihood. Let's go ahead and take a look at the specific breadth of numbers now. And you can see it was ugly out there. We've got the S&P 500 pulled up in the index watch area of the Thinkorswim platform, and only 30 out of 500 stocks were up here today. And that is only 6% of the index, for those of you that would like to think about that from a percentage perspective, meaning that 94% of components within the S&P 500 closed in the red here today. It was ugly. So whether we get any sort of a snapback or not remains to be seen. But one thing I found particularly interesting is that the VIX hardly rose today. I figured I'd go over, check out the VIX, and we'd see that thing up there at like 25 or something. Nope. The VIX only rose to 19. And for those of you that aren't familiar, 19 was once upon a time thought of as a low price for the VIX. Therefore, on a day when you assume volatility is just going to be going bananas to the upside, we really didn't see that. So I don't know what to make of that, other than it is quite odd. It felt a little bit more hairy today to me, but maybe I felt it differently than other people, right? Maybe there really wasn't as much selling as it seemed, but that definitely caught my eye there. I figured the VIX would have risen much more aggressively than it did. It was only up 5% today. Now I know that the VIX is a percentage, and you really don't give a percentage increase on a percentage, but just to give you an idea there, the VIX was up less than basically 1 full point, or 100 basis points. And this is the type of day where there was pretty heavy selling across the board that you would have figured it would have been a much more aggressive move. Let's take a look at our charts now. And by the way, here's the VIX as well to kind of give you a better bird's eye view on this. Notice that we've had the VIX selling off. We were positioned here on the VIX at about 23 on, let's see, it was February 21st. So, maybe 2 weeks ago or so, we were at 23 on the VIX. And as the stock market has been kind of hanging in there reasonably well, the VIX naturally declines. That's the typical MO of the VIX. When the market does reasonably well, the VIX goes down. When the market does poorly, the VIX goes up. But this kind of puts things into perspective that after today's what felt like a pretty aggressive sell-off in the market, the VIX has only managed to get back to where it was trading just 2 days ago. And as I mentioned before, remains below 20. You can see this kind of red line on the chart up here represents the 20 level on the VIX. And you can see how over the last year or so that it's been fairly rare for it to be below 20. And so even including today's big sell-off in the market, we are still at what would be generally considered a pretty historically low area for the VIX. So there doesn't seem to be a tremendous amount of fear, at least at an institutional level, if you're judging that by the VIX itself. But let's take a look here at the S&P 500. And you can see that it was a pretty aggressive sell-off day when compared to other similar days this year. By my eyes perspective, this was the third worst day of 2023. The worst day, by the way, was just a week and a half ago or so, right here on that February 21st. There we were down, let's see, it was just over 2% on that day. We had another candle that was very similar to today's activity, and that would have been right over here, or I should say bar. And this bar was down 1.55%. Today, the S&P 500 was down 1.53%, so just shy of eclipsing that particular sell-off day. And then the cutoff for the time for a calendar year is right here that I'm kind of circling. That's the crossover. So naturally, we had plenty of days last year where we had much more aggressive sell-offs. But so far, here in the first 2 months plus of 2023, this was the third worst day that we've gone through here. Again, mostly courtesy of Jerome Powell. It was also kind of interesting looking at what happened with interest rates. Some of you saw my tweet here just a moment ago talking about the 3-month Treasury bill. It cracked 5%. I think I've got a tab pulled up here to show you that a little bit better detail. You can see that the 3-month Treasury bill is now at 5.018%. And as you can see, I've got the all-time chart pulled up here because I wanted to go back and see how long ago it was since we were last at a 5% plus 3-month Treasury rate. And we would have to go back about 16 years to 2007, 2006 time period. So here's what the 1 year looks like for those of you that are curious. Remember, 1 year ago, we had the 3-month Treasury bill yield at 0.33. And now it is 5.01. We are talking about a monumental rip higher in Treasury yields, and so there most certainly is an alternative now. As for many years we were talking about that whole TINA argument, or TINA acronym, that stands for there is no alternative. There most certainly is one now, because in the past, anybody that was dabbling in the bond market was likely just doing so for diversification purposes or perhaps by mandate. Remember, there are some insurance companies and other institutions out there that are required to have a portion of their money in the U.S. Government bond market. But most retail investors probably were not particularly interested in doing that, and the reason for that is there was just not enough of a reward possibility for us retailers to stash our money in this particular area. Well, now there's a real reward awaiting us for those of us that have extra cash on the sidelines. I think that's a reasonable place to be parking it at this moment in time, assuming you don't need the money in the next 3 months. So anyway, I thought that was quite fascinating today as well. I did see some other commentary online about some of the deepest inversions of the various yield curves out there, going back quite some time, in some cases going back as far as the early 1980s. So that may have had a bit of an impact on those banks that I had mentioned to you before, because remember, banks generally don't like inverted yield curves, at least at a broad perspective. There's always exceptions to the rule, but in general, banks want to be able to basically pay you next to nothing on your savings accounts, but loan you out money at very high rates. And an inverted yield curve is not allowing for that. It's basically doing the exact opposite of that. And so it is a scenario where the banks see their profit margins get squished a little bit more so than shareholders would generally appreciate. So that, I think, played a little bit of an element of why the market sold off today as well. So anyway, it was more than a 1% sell-off day for the S&P 500. And it does mark the third worst day that we've had so far here in 2023. By the way, the Dow also got smoked here today, even worse. The Dow, I'm just using DIA here as my proxy, was down 1.74%. And you can see what that candle looks like here today. It looks like it was also the third worst day for the Dow. So it also had the worst day on the 21st of February and the second worst day here back on January 18th. And then today's was the third worst. But that's been a much more exaggerated type of movement that we've seen here lately out of the Dow that was not present as often last year as what we saw with the other indices. It's not that it was non-existent, it just wasn't as present as it was with some of the more speculative indices. But this year, the Dow's been blitzed. In fact, the Dow has given back all of its gains year to date. Take a look at this label up at the top of the chart where it says year to date minus 0.74%. So the Dow is no longer up on the year. Most of the other indices, I think, still are. So like if we went to the S&P 500, it's still up almost 4% on the year. The Russell is up 6% on the year, despite getting hit pretty hard yesterday and then following that up with another sell-off here today. And then the Qs are up 11% this year. Now remember, that's a little bit different. This is the NASDAQ 100 here, so it might be a little bit different on the composite. Nonetheless, we have had a nice little rally out of some of those mega cap tech-oriented companies that make up the NASDAQ 100. And so, that's an area that still is retaining a lot of their gains. But do keep in mind, the NASDAQ got hit a lot worse than the Dow last year. The NASDAQ was down 33% last year, remember. So, if they're getting a sharper rebound this year, it's not entirely surprising from that perspective. Anyway, I thought that was kind of interesting today as well, with the Dow being the first of the four major indices to now give back all of its gains in 2023. Let's go ahead and now take a look at our normal charts and look at our 4 grid here. This is chart 4B. And we are back to bearish postures on 3 out of the 4 charts. Remember, when I was with you last week, we were bearish postures on all 4. Remember, David does the videos on Friday and Monday. So the last time I was with you would have been Thursday, and that would have been the candle on the Dow on Thursday. That would have been the candle on the S&P 500 on Thursday. That would have been the candle on the NASDAQ on Thursday. And that would have been the candle on the Russell 2000 on Thursday. So when I was last with you, we were already 4 for 4 strongly bearish postures. But because we had a pretty solid rally in a couple of those days in between, some of the postures flipped back to weakly bullish. Note that none of them went to strongly bullish. And remember what I tell you regularly when it comes to looking at the lighter background colors, either pink or green, it's just giving you a heads up that a change could take place. Not that it actually is, it's just that that's more fertile grounds for that activity. Sometimes I've described that in the past as kind of being storm clouds. We don't know if the storm clouds are going to pass or whether the storm clouds are actually going to bring a storm. It's just a heads up that there's a heightened chance of a storm taking place. So anyway, those bullish storm clouds, I guess you could call them, blew away quite easily, and we were back into the more difficult selling types of conditions that had existed for much of the last couple of weeks. So the S&P 500, as I mentioned before, is down 1.53%, and we are back to a strongly bearish posture. We also have a red 30-day moving average telling us prices below a falling moving average. You'll also notice that on both the S&P 500 and the Dow Jones Industrial Average, we have those orange labels up at the top of the charts telling us that today's high to low range was more aggressive than the average true range, whereas the 2 charts on the bottom, the NASDAQ Composite and the Russell 2000, are listed there in those blue labels telling us the opposite. So that doesn't often happen, and usually in a day like this, it doesn't shake out the way that it did. In other words, typically when we have a big sell-off day, it would be more likely that the NASDAQ and the Russell would be more aggressively sold off, and the 2 kind of large cap and mega cap indices up top might not sell off as aggressively, but today was kind of one of those opposite types of situations there. Anyway, on the Dow Jones, you will notice that it was able to maintain its weekly bullish posture, but as you can imagine, because this is what I bring up to you regularly when I see this type of a chart situation, I'm not sure how much I can trust that, right? In other words, it takes a little bit more convincing to my eye. I'm not just going to trust that because the market forecast technical indicator is telling me that this is weekly bullish, that's what I should be with this index. Instead, I'm going to tread cautiously around that concept and wait for it to breach the 30-day moving average and prove it to me that it can stay above that. Right now, you kind of have conflicting information. In other words, you've got the technical indicator down below with this green line coming out of the low reversal zone, giving us some signs of hope. On the other side, you can see that the 30-day moving average is being used as resistance and clearly rejecting it to the downside, which is more of a bearish feature. So you have two things that are at odds with one another on the Dow chart right now. And if I had to guess, my guess would be that it would be breaking to the downside and that this green line will turn around at some point as well. I obviously don't know that for sure, but that would be where my hunch is, given the more aggressive selling activity across most stocks here today. Note that the Dow is in that same red 30-day moving average that the S&P 500 is, telling us price is below a falling moving average. Down below now, we do have the NASDAQ composite, and it was down 1.25% today. And by the way, I don't know if I mentioned this, but the Dow was down 1.72% today. So the Dow was actually today's worst performer. You had some pretty large companies in the Dow like Caterpillar and Goldman Sachs that were down more significantly. And remember, the Dow is price weighted as opposed to market cap weighted. And so with stocks like Caterpillar and Goldman Sachs, they have share prices that are above $200 per share. So they're going to have a little bit of a bigger impact than, say, something like a Walgreens, which is below $50 per share in the Dow. So I think that played a little bit of a role there as well. So the Dow was today's worst performing sector. The S&P 500 was the second worst performing I'm sorry, not sector, but index. And then the NASDAQ composite was the third worst performing index. It was down 1.25%. And with that move, you can see we now have a dark pink background color, telling us this is a strongly bearish posture. However, what makes the NASDAQ a little different than the others out there is that, notice, it's the only one that does not have a red moving average. And the reason for that is the moving average is still going up. So there's another sign of conflict there, where the NASDAQ's price action has been more robust than what we've seen out of the Dow. And this is kind of the opposite, right? Here we've got, a red background because that green line rolled over. You can barely see it with your naked eye down below, but it is down just a touch from the prior day. So it paints that background color of the chart dark pink, but the path of least resistance continues to be the upside on the NASDAQ composite until that moving average rolls over. That's the only index that can make that claim, which probably suggests that it can't hold up, right? Obviously, anything's possible, but odds are starting to suggest that with the other indices rolling over, it would probably be just a matter of time before the NASDAQ composite did as well. Anyway, as we can see over here on the Russell 2000, it was actually today's best performing index, but it was still down over 1%. It was down 1.11% to be precise. But do keep in mind that yesterday the Dow and the S&P 500 were up and the Russell was down tremendously. So today is a 1-2 punch combined with yesterday of selling for the Russell 2000. So that might very well be why it was down less than the other indices today, because it was already down sharply yesterday. So part of the beating that it needed to take was taken yesterday, in addition to a follow-on to that here today. So anyway, as I mentioned before, this is kind of interesting that the Russell's still up over 6% on the year. The NASDAQ composite, which is a little different than the NASDAQ 100, is up over 10% on the year. The S&P 500 is up basically 4% on the year, and the Dow Jones Industrial Average, no more gains on the year. It is actually down 0.88% here today. So another way to determine that the Dow, has been our laggard at this point, and that there has been more promising opportunities in the other indices. And that's kind of the exact opposite of what we experienced last year, when it was those big blue chip dividend paying, cash flowing machines out there that kind of helped retain capital much better than the more speculative areas. This year has very much been the opposite of that. You can also see, by the way, that the Russell 2000 small cap index does have a strongly bearish posture and a red moving average, meaning that price is below that falling 30-day moving average in that case. So not a whole lot of good activity here if you want to be bullish in this market here. And so you can send your notes of thanks to Jerome Powell if it makes you feel any better, because I think that's what most market participants are pinning today's selling activity upon. Let's go ahead and stop on over here to the internet briefly. I always like to get a chance to say thank you to those of you that help support these presentations. Of course, we try to do them as actively as we can. And I always say that as long as we're up and over 100 likes, I'm more than happy to give you a full-length video the next time I'm scheduled to do it, which will include 12 grid analysis and sector selector analysis and a trade application example, etc., etc. And of course, on Thursday, that's when I presented the Cisco bullish trade idea to you. And on Friday, we got out right away. So I'm hoping that some of you appreciate the success of those trades. And I hope amongst the 109 of you that took the 5 seconds out of your day to click like, that was part of the reason there. Of course, hopefully there's other reasons as well, including the education that David and I give you during these presentations. But remember, we don't make money doing these videos. And so it does take 3 hours out of our day, and we have to make sure that we are using our time wisely. So if you want us to, encourage us to continue to do the videos, then we ask one simple request out of you. Just simply click like for us on Twitter. As long as we're up and over 100, happy to do those full-length ones. And thank you to the 109 last time, including Brandon, and including Brian, including Sandeep, including John, and Nietzsche, and TS, and Lucius, and Stock Market Junkie, and David, and John, and Walter, and Phil, and Christopher, and Doc, and Glenn, and Linda, and Valerie, and Margie, and John, and Charles, and Jim, and Fun Jonesy, and Das, and Paul, Roger, Sonia, and others. I can't get to all of you, but I do appreciate each and every one of you nonetheless. So if you want to see these videos continued as actively as they have been, we would encourage you to continue to help support us in those efforts as well. And thank you again very much. It means a lot to us. Let's have a little chat here about the sector selector now. Remember, this gets put together on Friday evening, so it is a couple of days stale by the time we do these free videos here on Tuesday. But for those of you that are premium members, of course, you have access to this immediately on Friday, and we do end up talking about it in my Monday top-down trend trading class as well. You'll notice here that the industrials were the #1 sector for the second straight week. Obviously, today's selling probably didn't help that all that much, but then again, I did mention before that the airlines were up today, right? Delta and a few of those were doing well, so maybe they hung in there a little bit better than you would have assumed. So anyway, industrials, consumer discretionary, and healthcare all shared the exact same rankings as the prior week, as did technology, by the way. Usually I just talk about the top 4 because that's what our focus is for my Monday class. But technically, you saw that technology also kept the same ranking as did consumer staples down below. So that means at least in the top 4, there was only one change, and that change was materials and financials flip-flopped. And again, remember, that flip-flop did not occur because of what happened to the banks today. This already took place on Friday. And obviously that's not going to work every time, but in this case, if somebody would have lightened up their exposure to banks on Friday when I published this, they would have maybe avoided some of the pain that came with the banks here today on Tuesday. That might be asking a lot because usually you're not going to be that active based upon this information, but you never know. It is kind of cool to see this information work the way that it's supposed to, though. And it was already giving us a heads up last week that the financials were falling out of favor, and there was a slight improvement there within the materials. Note that we do still have real estate and utilities down below here at the dead last positions. Those are more interest rate sensitive areas, and so when interest rates continue to climb and climb and climb, those areas might be out of favor on a relative basis because they're oftentimes viewed as bond-like proxies, in addition to having very leveraged balance sheets from an operational perspective, which does tend to have investors questioning their interest repayment capabilities and wherewithal, and what that means for ongoing dividends after that. But in addition to that, of course, the bond-like proxies, if you've got a 3-month Treasury bill from the United States government being offered at 5% right now, and you don't have to take any risk with it at all, you can see why some investors are taking the government up on that offer and saying, you know what, I don't need Con Ed, I don't need Southern Company, I don't need Duke Energy, I don't need all these other utility companies, I'm just going to go with the U.S. government. Now, the government is not going to raise your income the way that those dividend stocks could, but the dividend stocks could go belly up, right? There's no guarantees in this world, and the odds are highly favorable that the U.S. government will not go belly up, and so they have never defaulted on their debt in their history, and I don't anticipate that they will anytime soon. And so that's where, again, that conversation of there is no alternative is no longer the case. There are alternatives, and some people are taking the money that they had once earmarked for REITs and utilities and funneling that over to the U.S. government and getting 100% safe, guaranteed 5% yields out of those governmental entities as opposed to taking the risk in the stock market. All right, let's go ahead and pop back on over here to the main part of the Thinkorswim platform. And let's start doing some 12 grid analysis, starting with chart 5A. And as you can see, we've got a nice mix of green and pink charts here on the board in front of us. And so that tells us that we have both bullish and bearish postures depending upon what it is that we're looking at, which is very common with these this particular 12 grid here, which focuses on a wide variety of financial markets out there. It's not just stocks. So let's have our chats here. First things first, the dollar really catches my eye down below in the lower left. That thing just skyrocketed today. With all the talk about yields, I didn't really hear a lot of people talking about the dollar, but my goodness, that was a massive move out of the US dollar. It was up 1.24%. And while that might not sound like a lot if you're somebody that trades like Carvana or something like that, that moves like 10% a day type of a thing, the US dollar, of course, is a massive, massive amount of money that changes hands, billions, if not trillions of dollars. So a 1% move upon that is an extraordinary feat. You can see that just looking at the size of today's candle. So let me right click and maximize this so we can see it a little bit better. Take a look at this candle all the way off to the right-hand side here, and then compare it to all of the other candles on the board. We had one other aggressive candle, but that was a selling candle over here on January 6th. This is probably the most aggressive buying candle on the board for the US dollar in the last 3 months. Now keep in mind this is UUP, so it's an ETF that tracks the dollar versus a basket of other currencies. So some currencies might not have done as badly as others. Nevertheless, the dollar is oftentimes perceived as a little bit of a flight to safety within the currency world, and I wonder if there's a little bit of that taking place here today. And of course, there's always that possibility that with interest rates continuing to go higher and higher here in the United States, there could be very well a lot of people internationally and overseas that want to tap into the high treasury yields that are available to investors. And if that's the case, they might need to exchange their euros and their yens and their yuan and everything else into US dollars, causing that demand from selling their home currency and buying the US dollar in order to then funnel that money into the US treasuries where they can earn that above average yield compared to their home country's own government bonds. And so there's a possibility that that is taking place behind the scenes as well. But this is not a good sign. As I always say, I would much prefer as an investor to be operating in a weak dollar environment. And I know that sounds a little bit peculiar. For those of us that live in the United States, I think the assumption for a lot of people that aren't involved in the financial markets is that we should all want a strong dollar. Well, if you do a lot of traveling overseas, perhaps that's the case. But if you do very little traveling overseas and you're mostly, putting your net worth into the stock market, you traditionally don't want a strong U.S. dollar. There's obviously some exceptions to the rule to that, but in general, the vast majority of stocks do poorly when the dollar is too strong, and that has been a concern here. As you can see, as soon as the dollar turned around, starting here at the end of January, that's exactly when the stock market topped out and started going down. And so that's one of the market's problems right now. We have this big up candle on the dollar today. We have this big down candle on the U.S. stock market today. And of course, it wasn't just U.S. stocks there. Foreign stocks did even worse, which is oftentimes the case. EFA was down 1.67% today, and EEM was down 1.68%. So they nearly matched one another, regardless of whether you were talking about the developed foreign stocks or the emerging foreign stocks. They both underperformed the S&P 500, which already did pretty poorly for itself. So all three of them did poorly. It's just that the foreign stocks did even worse, because they are 100% on the opposite side of the US dollar, whereas there are some US stocks, that really don't have a big exposure to the rest of the world. We tend to think of the McDonald's and Coca-Colas and all those types of companies, which certainly do. But remember, we also have plenty of banks and utility companies and REITs here in the United States that have very little exposure overseas. So that relationship kind of held true to what you would expect here today in that regard. Anyway, you can see over here that the 10-year U.S. Treasury yield is approaching 4% at the moment. It was actually down just a touch today, despite a lot of the shorter-term interest rates going up. And again, that was part of the problem that the market had today, is that some of these longer-term Treasury yields are quite low in comparison to the 3-month and the 2-month and the nearer term maturities for the U.S. government, causing that inverted yield curve. So we're kind of hanging out here at elevated levels on the 10-year, but it could be a heck of a lot worse. I mean, in reality, we could see the TNX go to, let's say, a 5% yield, and it wouldn't be particularly astonishing given what we know about the short end of the curve right now. So, I would be curious how the stock market is going to react if that is in the cards, and I would not guess that it would react too well to that. So we shall see if it does unfold in front of us. You will see here in the middle that our commodities struggled today. Remember, that is oftentimes the case as well. When the dollar is strong, since commodities are priced in dollars, they are weak. And that is exactly what took place today. Gold fell precipitously, down 1.75%. Remember, I was talking to you guys about gold here a couple of weeks ago when it finally printed that oversold cluster signal. I said, it's a possibility that we get a little snapback reversion to the mean rally, but I was emphatic in telling you that I would not assume, unless I saw with my own eyes, that it would be a trend-changing type of a move. And right now, we can see that is likely kind of playing along with what I was portraying there. In other words, yes, we had a week's worth of a rally back to that falling moving average, but the prior downtrend is still in play, and we are in jeopardy of actually breaching to new multi-month lows on gold. We would just need to go down maybe another 0.5% or so. So that could happen as soon as tomorrow, and we might be down below that candle that set the oversold cluster signal there. So rather short reversion to the mean, but you did get it. So maybe that helped you unwind some of your bullish gold trades had you still had some. Remember, I did one bullish gold trade, but that was during the month of January, and we were able to successfully shut that down at max gain. In this most recent expiration period, we have not had any bullish or bearish gold trades. We're just kind of watching from the sidelines, but if I were forced, I would probably be on the bearish side of the equation given what I see out of it right now. Oil's actually been holding up quite a bit better, but today was a pretty lousy day for oil. It was down 3.75%, but because it had rallied so aggressively in the past week, you can see it still retains its green background color. So, kind of a rare case where you've got a strongly bullish posture according to the market forecast. Down below here, notice that the green line is still rising on USO, our proxy for oil, but at the same time, you have a red moving average. You don't see that all that often because, again, they are two conflicting signals, and we're not just talking about a weekly bullish posture here. This one would be considered strongly bullish. At the same time, we're trading below a falling moving average, but these lines down below do have a delay to them, right? The red line reacts almost instantly because it's tracking the smallest amount of time. The blue line is the second most sensitive because it's tracking a little bit more time than the red line, but not as much time as the green line. And then the green line is the least sensitive of those three colored lines. And so it takes maybe a few days of reaction before you can see the movement on that green line. So think of it as kind of like a little bit of a grace period, just in case there's a head fake or two that you would have been clipped on otherwise. So oil is kind of still in that sideways tracking mode that we've seen for pretty much the vast majority of the last 2.5 months. In terms of the bond market, we did see high yield bonds get hit hard today. They were down 0.71%. But remember, when oil has an aggressive day, it tends to have an impact on the high yield bond market. So notice that when oil had all these big days here within the last week, you saw that the high yield bonds went up on days when these other types of bonds went down or just had very small up days. Today was the opposite. Oil got smoked today, and high yield bonds got hit a lot worse than these other two areas. And while that sounds a little confusing maybe at the beginning, if you understand which companies are made up of the kind of high yield junk bond market, there's a lot of oil companies in there. And so there's a little bit more of an emphasis or an impact, I guess you would say, in the high yield bond market upon what's been going on with oil at any given moment in time. Long-term U.S. Treasuries and foreign bonds actually managed to close in the green today, not by a tremendous amount, but nonetheless, they were a little bit of a safe haven in the selling of the more aggressive stock markets that were out there. Long-term U.S. Treasuries were up 0.61% and foreign bonds were up 0.10%. But similar to the high-yield junk bonds, all three of them continue to have their strongly bearish postures. Bitcoin has been a little bit more erratic here lately. I had to chuckle when I was with you on Thursday last. We were talking about how Bitcoin was kind of holding its own up there, and it was a little surprising because, we had some sell-off days in the market, and usually we had seen Bitcoin kind of give up the ghost prior to that. So I was trying to, do my best to praise it a little bit in that regard. Well, literally within about a half an hour after I stopped recording on Thursday, Bitcoin just collapsed. I don't even know what the reason was behind it. I didn't see the news story. There was probably something, but I don't really keep up too much in that particular field. But I just thought the timing was kind of hilarious because I had just recorded that it was doing pretty well. And then as soon as I got out of my recording, it took a nosedive. It was down like 4% in just a couple of minutes. And so all of a sudden, you can kind of see where that air pocket was right here, by the way. And these charts, remember, Bitcoin kind of trades around the clock, so it's a little bit of a different type of a chart than some of the others that kind of have an end time, so to speak. But notice that at a high level, Bitcoin is now back below its moving average. The moving average is still rising, so that's a good sign. But we've now breached that 30-day moving average for the first time since the first week of January. We had an enormous rally in Bitcoin to start the year off. Much of the last month has been, just consolidating those gains sideways. And now you're kind of getting a little bit more of an impression that, hey, you might need to give back a little bit more of those Bitcoin gains, given what we now know about the markets. All right, let's go ahead and now take a look here at our sectors. This will be chart 5C for those of you that are following along at home. Here's a little bit more of a mixed bag as well, which is maybe a little surprising to me. I figured after today's heavy selling, we'd see a lot more of a consistent pink hue on the charts, but we actually still have some green charts out there. So let's talk about those first, because it's always more fun to talk about what's been working reasonably well, even if today was such a sour day for investors. So let's start in the upper right-hand corner. There's technology. This is XLK, so remember this is the market cap weighted sector ETF, not the equal weighted one. Sometimes there are small differences between those. But in this case, you can see that we have held up reasonably well with technology. Microsoft and Apple were both down today, but remember they were only down a little over 1%. So it wasn't like they got mauled today the way that, let's say, the banks got mauled today. Notice, for instance, when you look at the financials candle over here, that looks really, really ugly. One of the worst candles on the whole board out of the financials today. And then compare that to technology, it wasn't nearly as bad. In fact, the financials were 2 times worse than technology today, right? XLF was down 2.58%. Technology was only down 1.24%. And so that's a little bit odd, right? Usually when you have a big aggressive movement day, technology is a higher beta area that oftentimes leads to the upside or to the downside, but we didn't really get that today. Today, instead, it was kind of more of a concern about the yield curve inversions and what Jerome Powell was saying, and maybe there's not as much of an impact on technology when it comes to that, right? Technology sometimes gets impacted more by, supply chain and, geopolitics with China and the United States and that sort of thing. So anyway, technology does retain its strongly bullish posture right now and actually is still barely, by the slimmest of margins, trading above its rising 30-day moving average. Notice that industrials is also in that strongly bullish category where it had a similar give back today to technology. It was down just 1.29%, so it actually did better than the market at large. Again, part of the reason behind that might have been because Delta and United and some of those airlines did a little bit better today. They're part of the industrial sector. But it was still a pretty aggressive looking candle there. Not nearly as bad as like this one back here on January 18th. Nonetheless, you gave back a big chunk of the recent gains in just one fell swoop here today after being so close to multi-month highs. In fact, not all that far away to all-time highs on the industrials. So anyway, with industrials, you can see that they retain their strongly bullish posture. They continue to also have that upward trending 30-day moving average, and price remains above it for the time being. So both industrials and technology are the only two from a market cap weighted perspective that can make that claim of having bullish postures and are still above their rising 30-day moving averages. All the other sectors cannot make that claim for various reasons. There are still a handful of other sectors that have light green background colors, which includes energy, utilities, and staples, but same thing as what I mentioned to you earlier about the Dow Jones. I'm not going to really trust that any more than I can throw it. In other words, path of least resistance on those charts, in my eyes perspective, continues to be to the downside. That's why they're trading below their falling 30-day moving averages. So the market will need to prove it to me for me to maybe get a little bit rosier with my outlook in those areas. Now, naturally, some of those areas, in particular staples and utilities, are good hunting grounds for dividend-oriented investors, and therefore this major sell-off we've seen in those specific sectors has created some interesting opportunities. Earlier today, of course, I did teach my dividend growth investing class. We're currently in week 10 of our 25-week portfolio build-out period. And so we've had a lot of fun in that class and learned a number of things along the way as well. But one of the more interesting elements of this year is how the very areas that dividend investors are interested in are the ones that are kind of being served up to us on a silver platter right now. And usually we're not that lucky. Usually when the market sells off, those defensive areas hold up better. And we're always kind of wishing they would kind of pull back and sell off a little bit harder. Well, right now, they're actually doing worse than the market. And so there are some interesting opportunities presenting themselves out there. Anyway, in terms of the red charts on the board, that's pretty much all the rest of them. The worst performing sector today was the financials. Second worst performing sector was real estate. They were both down just over 2.5%, and not a single one of these sectors closed in the green today. So it was a sell-off across the board. No surprise there, again, now that we know that only 6% of stocks in the S&P 500 managed to close in the green. Naturally, all 11 sectors are going to struggle on a day like that. So tough day there for the bulls, given back quite a bit of the recent gains in one fell swoop. And of course, we're going to hear more from Jerome Powell tomorrow. So kind of buckle up, expect additional volatility one direction or another. Let's go ahead and get into our trade application example now. And for that, I am going to pull up chart 2A. Many of you know that when we have a market sell-off day, generally speaking, the way that my mind works is when we are down more than 1% on the market, and if that happens to be a Tuesday or a Thursday when I'm scheduled to do the market outlook video, I am more likely than not to go out of my way to look for sold put ideas for you guys in the video that night. And remember, I do these trades when the market is open, and therefore I can get out the trade details to those of you who are premium members members. And again, going back to that Cisco trade on Thursday, remember, those of you that are premium members would have known about my trade before the market closed on Thursday. Everybody else who's not a premium member of Market Scholars would not have found out about that trade until watching the free YouTube video that night. And therefore, by the time the market was gapping higher on Friday morning, it would have been too late for everybody in the free video to do the trade at the level that I did the trade, and therefore they would not have been able to get out at max gain. Now again, I want to stress that that is very rare, but that's a good case in point as to the value that our premium members get of having access to our real-time trade alerts that we send out to you. So make sure you're taking full advantage of that. So anyway, point being, I do try to get those trade alerts sent out to you guys in that final half of an hour before market is closed, so that way you guys can consider the trades for yourself. And that was the same as today. And so on a day when the market is down over 1%, I usually look for those sold put trade ideas where I'm looking for a company that has a longer history of growing dividends, that is now in attractive territory where I can sell a put with a strike price well below where it's currently trading, with the hope that I either get the benefit of taking in premium by selling that put initially, or getting to buy that stock at a lower price than where it's currently trading. Some people kind of would refer to that as getting paid to place buy limit orders on stocks at lower prices. Now, it's not exactly the same as that, so we've got to be careful with how we present that. That's what other people say. I don't really say that, because I know that just because you sell a put on something doesn't mean that you're actually going to be put that stock, even if it goes down below the strike price along the way. If it closes below the strike price, then yes, you can assume that you will be put that stock. But if it goes down below the strike price during the life of the trade and then pops back above it by the time the expiration day hits, then you would not be entitled to the stock in that case. So got to be careful with that mindset, but it's at least a good kind of high level way to think about the trade if you've never really thought about it before. It's basically a way to clip a coupon and get a lower price on a stock that you already might have an interest in. And there's been plenty of stocks I have been able to choose from in that regard lately, because of what I've mentioned before. A lot of the dividend stocks have been getting hit worse than other stocks here so far in 2023, and Whirlpool is no exception. This is ticker symbol WHR, of course, the company that makes lots of dishwashers and washers and dryers and all kinds of things like that for the home. And naturally, with interest rates surging, mortgage rates are also high, and people are wondering if there's going to be a major slowdown in the housing market, and that could certainly negatively impact Whirlpool. So if this is not a company that you have an interest in owning, you should probably pass on this trade idea, right? I always teach my options for long-term investors students on Monday afternoons that they should only sell puts on stocks that they actually want to own if push comes to shove at lower prices. Now, the reason that Whirlpool hit my radar is not necessarily because it's my favorite company or anything like that, right? Last week I talked about Johnson & Johnson as as another example, and I am a much bigger supporter of Johnson & Johnson. I just think it has a much better business model, and I feel more comfortable with it, that I can trust its business model in good times and bad and all that kind of stuff. I don't really feel that way about Whirlpool, though I do respect it. It is a company that has a longer history of growing the dividend. One thing that did catch my eye, however, is they have now just reported their fifth straight dividend at $1.75. And oftentimes in the past, they had raised their dividend after every 4 quarters. And so hopefully that's not a bad omen for Whirlpool, but it could very well be the case. So we want to keep our eye on that. You can see that Whirlpool is now trading in this blue zone of the dividend stair-step chart, meaning that this has been considered a more attractive area from a dividend yield perspective when we go back and judge its yield history over the past decade. And so what I ended up doing in today's case is selling the April 120s, I believe. Let me just verify that. April, yes, 120s. And I sold those at $1.35. Now, a reminder that our sold put trades have actually done pretty well. Some of you might be thinking, boy, with the stock market getting hammered today, I bet Brandon's sold put trades are doing poorly. That's not the case. In fact, I was noticing that we have a clean sweep of profits right now on all of my open positions for the Market Outlook video. It's somewhat rare when that is the case. So you'll notice up here with our Iron Condors, ACN and Berkshire Hathaway, Danaher, and Southwest Airlines all have profits. Southwest just barely, but $2 to $2. I also have a bull put spread on not Stanley Black & Decker, but Skyworks Solutions. And that's up 27 bucks. And then down below here are my sold put trades that I've done for you guys in recent videos, including Baxter. There's the aforementioned Johnson & Johnson, and there's Norfolk Southern, which was down tremendously today, over 3%, yet we are still making good money on this trade, up, capturing about 45% of our max gain on that so far, despite these being bullish trades, right? I actually only have one bearish delta of our open orders in this account right now, and that's on Berkshire Hathaway's Iron Condor, which is a very small delta. So despite me having almost exclusively bullish deltas at this moment in time and the stock market getting absolutely annihilated today, we have nothing but profits in all of our open positions, including the one that I just put on today in Whirlpool. So remember, it's not necessarily that you have to be precise and have perfection in the world of trading. A lot of times, strategy selection is equally as important as what you are trading. And in this case, I'm giving myself plenty of extra flexibility by selling the 120s on Whirlpool out in April. It allows for this trade to lose another $15 per share before I start feeling heat in this position. And at that point, it would obviously have a much higher dividend yield than it already does, which for Whirlpool is already above a 5% yield. So this is a rare company in the S&P 500 that's yielding more than the 3-month U.S. government treasury as well, which might be another reason that it is enticing to some of you out there. So that's what I had for you. A sold put trade on Whirlpool that is now in the attractive blue zone of the dividend stair-step chart. And by the way, one last little bonus. If you look at the monthly chart, it has an oversold monthly cluster right now, which is very rare, right? You had a couple of them over here in 2018, and then you had a couple of them way back here in 2008 and 2009. But generally speaking, this is not a company that has a whole lot of oversold monthly clusters. And usually you're going to get some sort of a rebound after that. This first one over here did not work so well. You did have a couple of months after that where it rose. That's all we really need for a sold put trade, right? We don't really need multiple months. We just need, 1 or 2 in order to get out of our trade. But like this one over here had a big rebound in the year after that. And these two that were right next to each other had a fairly big rebound in the year after that as well. So you'd like to think that we're getting kind of in that general vicinity of where a bottom could be in the works here for Whirlpool, at least for a basic trade like a sold put like I presented for you here tonight. Okay, so if you enjoyed that presentation, if you liked the trade idea, if you just like the fact that I get these videos out to you at a reasonable time, whatever the reason is that you appreciate it, the way that you can share your appreciation with me is simply by clicking like there on Twitter. And as I always say, if we're up and over 100 likes by the time I'm scheduled to do the video on Thursday, I'll give you another full-length video. On the other hand, if you kind of don't get so much value out of these longer ones and you'd prefer me to just stay with a 15-minute version only covering the indices and none of the extra bells and whistles, then don't click like on Twitter. And if we're under 100 likes by Thursday, then I'll just plan on doing a shortened video on that particular day. So we'll let you guys decide collectively on that. Whatever you decide, I do appreciate you checking out tonight's video, and I'll wish you all the best of success with your trades and your investments. Goodbye for now.